Welcome, folks, to the presentation today, the webinar on SPAC investing. I'm your host, Julian Klymochko. We'll wait about 1 minute prior to beginning. Welcome, folks, to the webinar today, SPAC investing, positioning for the next bull market. I know there's been a lot going on in the SPAC space. We had a great bull market last year and into February. The market peaked Feb 19th, went on into a bear market, frenzy stopped, and now we are perhaps at the lowest valuations since the tail end of the pandemic bear market back roughly a year ago. So I'm pretty excited about the space, and I want to talk to you today about how to position your investment portfolio for the next bull market in SPACs, which is going to happen. So let's kick things off today. Check out the disclaimer here. Any forward-looking statements, expected returns, past performance is not a guarantee of future returns, etc. So to kick things off, I'd just like to do a high-level overview of what a special purpose acquisition company is and a review of the asset class. So I like to break down each decade into a specific financial innovation. Specifically, in the 1980s, that brought about the high-yield bond, the junk bond, invented by Michael Milken, which spurred the leveraged buyout boom, which effectively continues to this day. And the 1980s were really just characterized by that excess brought by the high-yield bond, the junk bond, but it was a great financial innovation that enabled lower quality companies to raise capital. Then in the 1990s, that was the decade of the mutual fund. So back then, we had star mutual fund managers, Peter Lynch, Michael Price, etc., gracing the covers of magazines, helming mutual funds such as Fidelity, Magellan, and they're super popular. Not too much these days. It's kind of a bygone era, but nonetheless, the 90s were really characterized by the mutual fund. 2000s, exemplified by complex credit derivative products, CDSs, CDOs, mortgage-backed security, credit default swaps, which fueled a great credit binge leading to the housing bubble, which popped and led to the 08-09 global financial crisis, which wasn't very fun. But those credit derivatives characterized the 2000s. They're still around, but not as important as they were. The 2010s were the low-cost ETF, really democratizing access to low-cost equity and fixed income investing, along with some other interesting types of ETFs, whether they're theme, alternative, leveraged, etc. 2020s, while still early, I believe this will be the decade of the SPAC. I believe we're still in the first inning of the asset class, and it has a long way to go to mature. Just a heads up that if you do have any questions, please put them in the chat. I'm going to answer questions at the end of the presentation today. So what exactly is a SPAC? Well, it's an acronym for Special Purpose Acquisition Company. It's also known as a blank check company. It IPOs, raises capital, but has no operations. And they seek to merge with a private company. And the SPAC serves as a conduit or a vehicle that a private company can use to go public. And SPACs generally follow a very boilerplate template when they launch. So the typical SPAC has a number of characteristics that generally they follow. So number one, they generally IPO at $10 per unit, and that unit is a stapled security. It contains common share and typically a fraction of a warrant. So it's generally between a 1/3 to 1/2 a warrant. Some are warrantless, 0 warrants, and some could be 1/5 of a warrant, a full warrant, and anything in between. Those are typically exercisable at a 15% premium or 11.50 for a term of 5 years, unless they're called early. Units can split into their constituent parts, common shares and warrants, after 52 days. When a SPAC raises that IPO capital, call it $200 million, they put that into trust and they cannot touch it. That trust can only invest in low-risk short-term T-bills. And if they don't find a deal, which they have a time frame, generally 24 months, to get a business combination done. If they don't, then they pay the trust proceeds back, which they sell the T-bills, and they distribute the proceeds to investors, and investors will get back $10 plus accrued interest because the T-bills that they own accrues interest. Relatively low these days, 10 basis points, but about 15 months ago, that yield was north of 2% when rates were higher. So there's another key aspect. If they do strike a business combination, prior to the vote, they allow investors of the common shares the ability to redeem for $10 plus accrued interest. So there's kind of two key aspects. If they liquidate, then you get $10 back plus accrued interest. So after 2 years, call it $10.20. If they get a deal, they put it to vote and give you the option to redeem if you don't like it. So standardized terms, and there's well over 500 currently outstanding. It's been a big bull market in issuance up until April. Specifically, 2019 was a record year, 13 billion in issuance. 2020 just crushed that, raising about 83 billion. And 2021 was a frenzy up until about a few weeks ago, or about a month ago. So SPACs raised about $100 billion year to date, 2021, but that has trailed off, as we can see on this slide here. On the right, the bar charts shows SPAC IPO issuance, the amount that they raised per month. So March was a record of roughly 34 billion. And that frenzied period between July 2020 and March 2021, SPACs were raising on average 18.5 billion per month, which was, I think, about 12 to 15x the previous 12-month average. So certainly increased dramatically. The graph on the right shows the growth of the asset class. 1 year ago, it was 20 billion. Now it is 200 billion. So 10x year over year growth with a dramatic increase in issuance. And that seems like a lot, 10x, and it is. But a $200 billion asset class size, it's still relatively small. It's only 8% of private equity and about roughly 10% of global hedge funds, and also a fraction of global venture capital. If we compare it just to the SoftBank Vision Fund, that's one venture capital fund, that's $100 billion. So SPACs are just double the size of one venture capital fund. So there's a lot of them, but still they pale in comparison to other asset classes. If you compare it to cryptocurrency, something like Dogecoin, I mean, SPACs are just 4x Dogecoin and smaller than Ethereum. So when put in those terms, they aren't too big of an asset class. And if we look at it compared to a stock, because SPACs, if all 567 of them did a deal, they typically do it at 3 to 5 times their size. So if every single SPAC did a deal, that would result in aggregate enterprise value of between 600 billion and $1 trillion. So that's basically one Tesla, just to put that in perspective. So many people ask, what is the purpose of a SPAC? Well, it's to bring a private company public. And so when a private company is looking to undergo a going public transaction, there's basically 3 methods of doing that. Simplest one is the direct listing, which does not contain a financing. They just list it and they're free to trade. And that's more so just a straight up exit opportunity for earlier stage investors and insiders, especially if they don't need to raise capital. So we recently saw one from Coinbase because they don't need capital. And we saw one from Slack, but that's really only for very popular companies or companies that just went through bankruptcy and are relisting. Then there's the traditional IPO, and the purpose of the traditional IPO has really morphed and evolved over time. I'd say pre-2000, it was used as a mechanism to truly fund the growth of early stage companies. You saw the Microsoft IPO, Amazon IPO, Apple IPO. These were used to fund their growth. These days, and it's developed over the past 20 years, an IPO, traditional IPO, is just an exit opportunity for private equity and venture capital firms. They're looking to cash out, and they cash out on the public markets when there's no more growth available. And so you rarely, if ever, see a traditional IPO to raise growth capital to fund a business's growth, as opposed to exit opportunity for earlier stage backers. That takes us to blank check companies. Now, blank check companies are typically used to fund growth of earlier stage companies. So they're basically what an IPO used to be. Not so much an exit opportunity, but more so the funding and financing of investing in companies and investing in the economy. So the SPAC has four main advantages over the traditional IPO. So number one, speed. You can generally go public in as little as 3 months. Traditional IPO can take 12 to 18 months. We all know markets are quite fickle. If we rewind 12, 13 months ago, or 12 to 14 months ago, we all remember markets in a tailspin, VIX at its all-time highest level ever, the markets going wild and just tanking with the spread of the COVID pandemic. So timing is key. 3 months can be certainly much better than 12 to 18 months. Then marketability. Another key aspect of a SPAC transaction is it's structured as a merger, the business combination, as opposed to a traditional IPO, which utilizes an S1. And through a traditional IPO, you can only utilize historical financial information. You can't discuss or provide forecasts or estimates to investors. Many earlier stage companies that don't necessarily have attractive historical financial statements, they need to market their story, market their stock to investors based on the future. That comes through forecasts and estimates, which you can do through a SPAC merger. There's a certainty of valuation in a direct listing. Companies have no idea where they'll trade. In a traditional IPO, companies find out basically the night before what the valuation is. And with a SPAC, that is determined, months before closing, with the discussion of just the SPAC sponsors. So private companies are negotiating with one entity. And then lastly, capital. A typical SPAC transaction for, I'll call it $1 billion company going public, they merge with a $200 million SPAC that has $200 million in trust and could have a concurrent $300 million pipe financing, bringing aggregate funding to $500 million, representing half the value of the company. There's no other place where a private company can raise half their equity market capitalization in one transaction. Can't do it within an IPO, can't do it within the private markets. So SPACs provide the most capital available to a private company looking to grow. So with respect to the natural buyers of SPACs, there was never really a natural buyer because they're peculiar type of security. No cash flows, no management team that's going to stay on, and really can't be judged by your traditional types of investors. For example, growth investors wouldn't buy a SPAC because there's no growing business within it. It's just a pile of cash. Value investors wouldn't buy it because there's no earnings to appear cheap on. Quality investors wouldn't buy it because there is no long-term management to judge its quality. Index ETFs wouldn't buy because they can't be part of an index, and they don't fit a specific theme. And many of the large indices require profitable companies. But there is one contingent of investors, because if you look at a SPAC as a high-quality cash risk arbitrage trade, then it has attracted risk arbitrageurs who know this type of trade very, very well and are comfortable holding it. So there is a life cycle to SPACs, given that hedge funds, such as ours, will participate in the IPO and be buying in the market pre-business combination for a SPAC. Once a business combination is announced, then you'll have, if the deal is attractive, typically they try to attract retail traders who will want to get involved after hearing about the story, whether it's a DraftKings or whether it's Virgin Galactic, anything like that. They like the story, they want to get involved, and they buy stock at a premium from the hedge funds. And then once the deal is closed, you have more so mutual funds and ETFs buying into it once the business combination is done and the new company is up and trading. So each one of these constituents has a role in the life cycle of a successful SPAC business combination. So there are two sides to the market on SPACs, the supply and the demand. So on the supply side, why would a sponsor issue a SPAC? Well, number one, the compensation is quite high. So it's a very lucrative sponsorship compared to, it would be comparable to private equity or venture capital in terms of, the 2 and 20 economics that PE and VCs generate. And so SPAC sponsors generate a return or compensation through two methods. Number one, in order to fund the SPAC, they subscribe to private placement warrants, which increase in value if the underlying stock goes up. So they typically put, call it 3% of the IPO into the SPAC in the form of private placement warrants to fund the working capital, the investment banker fees, the underwriter fees, the legal fees, etc. Because as you can remember, sponsors are not allowed to touch the cash and trust, which is raised in the IPO. The other portion of their compensation is the 20% promote. Or basically, they get 20% of the pro forma SPAC or 25% of the IPO proceeds as basically free shares. I mean, they pay $25,000 for them, but on a $200 million SPAC IPO, those shares could be worth as much as $50 million, 50. And therefore, it's a tremendous amount of compensation, very lucrative, which is why you see a number of alternative investment firms start to create SPAC business lines, SPAC manufacturing lines to just crank these out, whether it's TPG, Apollo, Oaktree, Social Capital, Dragoneer. Many firms in the private equity, venture capital, and hedge fund space are now serial SPAC sponsors. Then on the demand side, many view SPACs as venture capital 2.0 or the IPO 2.0, a better way to take a company public than a traditional IPO, which has a number of disadvantages. So the common misconception in public market investing and why we've seen such a growth in private markets over the past 2 decades is this misconception was that public market investors only want to invest in stable, growing, profitable businesses that are mature and always hit their quarterly numbers. But with the going public transaction of Virgin Galactic, I believe that completely crushed this myth, because Virgin Galactic is not only pre-profit, but pre-revenue, and the stock proved to be very popular with public market investors, specifically retail investors. And it was shown that there's a tremendous appetite for early stage growth companies that are analogous to a Series D or Series E type venture capital round. There's a ton of appetite for that from public market investors, whether it's Opendoor, Porch, Desktop Metal, ChargePoint, QuantumScape, any of those earlier stage companies. There's been a ton of demand for them. Recent SPAC performance. So we are in a bear market. We had a great bull market last year. SPACs were up tremendously, about 40%, which continued into February. February 19th, the market peaked. And as you can see, yields went to their lowest ever. SPAC arbitrage yields were -4%. And so investors were paying substantial premiums on Feb 19th. The average SPAC premium hit 27%, which is an all-time high in terms of valuation. Since then, the market's declined precipitously. It has bottomed. March 24th is about a 12% peak to trough decline. I've seen some SPAC ETFs do far, far worse than that. Some are down over 20%. But over the past month or since March 24th, we've sort of just bumped along the bottom. But as you can see, yields are once again positive, presenting very attractive place for investors to get involved and buy. I see many retail investors, messaging me on Twitter saying, "Oh, SPACs are dead." But these were the same ones telling me that they had no problem buying at $13, a 30% premium for a pre-deal SPAC 2 months ago. And so the key to investing is to buy low or sell high, or sell when yields are low and buy when yields are high. As you can see, 2 months ago, yields reached -4. Now they're positive, roughly 1%. And so it's a very attractive buying opportunity that is kind of similar to where it was in late April, early May of 2020. There's not a lot of asset classes where you can get similar valuations to that time period. So SPAC IPOs, those have really trailed off. They're down 90% in terms of issuance versus March. Month to date, there's roughly been a 2 billion in issuance, and March to date was about 20 billion. So substantial decline in issuance. We had the SEC come out with new guidelines for warrant accounting, which fundamentally doesn't affect anything to do with the SPAC. All it does is it delays the financials, delays a business combination if the proxy has not been approved by the SEC. And if you're looking to take a SPAC public, then those got delayed as well. So positive benefit, and there was a significant positive benefit to this new SEC accounting rule, is it closed the equity IPO window, the SPAC IPO window, which is tremendously beneficial to the market, because the one and only reason, or the main reason, I'll say, there could be some other lesser reasons, but the main reason we went into the bear market was there's just way too much supply. We had a tremendous glut, and there's more supply than demand. Econ 101 indicates that prices will come down. And that's what happened. There's way too much supply, and the market won't rally until we're able to work through that supply. So we're finally at the point where there's more business combinations being completed than IPOs being announced. And that is, or will slowly but surely bring down SPACs outstanding, allow the market to get its legs under it, and start to rally. And the thing that many investors don't realize is this market is highly, highly cyclical. And over the past years, we went through 4 cycles. In March and April, there's no issuance, bear market just due to COVID, then had a rally into the summer. Again, IPOs got too crazy. Then we hit an air pocket in demand. Prices declined into July, hit a bottom, and then once again rallied into late September, hit an air pocket, had too much supply, had a correction in October, hit a bottom in early November, had a tremendous bull market into mid-February. Once again, in an air pocket, too much supply, IPO issuance gets cut. Once again, we bottom March 24th, sort of bumping around the bottom here, but looks like, and my expectation, my estimate, is that we will hit a bull market on the back half of the year here. But remember, highly cyclical, always going from horrific sentiment, which we're in now, and 2 months ago, we had just, fanatical sentiment, the complete 180 degrees. And just remember, when it's bad, people think it'll always be bad, and it turns good at some point. And when it's good, people think it'll always be good, and it turns bad at some point. So that's the nature of cycles, and they always happen, especially at SPACs. They're highly prone to cycles, which happen a number of times per year. So it's hyper cyclical. But with respect to IPOs, there have been a handful in April, and long gone are the days of a SPAC rallying 5 to 7% on its first day of IPO, opening up at 10.50 to 11. Now we're more so opening up around $10, which is where they should be. So what we like to do is SPAC arbitrage, which in the current market environment, where we're at the tail end of a bear market, it is the golden age for SPAC arbitrage, because there's over 400 SPACs available at or below now, which is a pretty phenomenal opportunity set, in my opinion. So SPAC arbitrage is a method, it's an investment strategy to generate low risk yield, low risk returns by buying SPACs at or below their net asset value. So there's 4 key drivers of this arbitrage return. So number one, on the yield side, there's the yield of the underlying T-bills in the trust account. Currently, that's quite low, roughly 10 basis points. But if we rewind a year and a half, that was north of 2%. 2% return isn't too bad. Second yield generator is the net asset value discount. You're able to buy a SPAC unit at $9.90, which is a discount to its $10 NAV, then you can generate additional yield by the amortization of that NAV discount. Then there's 2 additional return drivers. Number one is the warrants. If you're buying the units, then you get warrants for free. And warrants on average are valued kind of $1 to $2. So if you get half a warrant per unit, that could be 50 cents to 75 cents in value, adding 5 to 7.5% to return. And then my favorite part of this trade is the upside optionality. On deal announcement, we have seen what we refer to as a SPAC pop rally tremendously in a more bullish environment. And we've had SPACs where we sell north of $12, $13, $15, even north of $20 per share, that rally post-deal announcement. So here's a primer on SPAC arbitrage. This is with the now infamous Nikola stock. Prior to becoming Nikola, it was SPAC Vecto IQ. If we look at the graph here, the orange line is the net asset value. As you can see, the share price in the blue line, it varies dramatically by the underlying net asset value, which creates an opportunity for enterprising investors and arbitrageurs. So if we go back about a couple of years ago to early 2019, the stock was trading around $10 and the NAV was around $10.30 due to the accrued interest. So there you could buy the stock at a 3% discount to NAV, locking in that low risk 3% return. Then fast forward a year, they announced a business combination with Nikola. Stock immediately popped from 10 to 15, allowing arbitrageurs to exit at a significant premium to net asset value, that orange line, leading to abnormal upside returns. Further commenting on the SPAC pop or the upside optionality on business combination, and it was a key driver for the exceptional SPAC arbitrage returns last year. If we look at CIIG merger, when they announced a deal with a rival, it rallied in north of $30 per share, allowing arbitrageurs to exit and a 200% plus premium to net asset value. Pivotal Investment Corp 2, they announced a deal with XL Fleet. That one rallied nearly to 20. In Longview Acquisition, they announced a business combination with Butterfly Network, rallying into the mid-teens. So that upside optionality, it's tougher to come across these days, but if we look at transactions like Rice Acquisition, it's still there, or the Grab deal. So the upside optionality, the SPAC pop, is my second favorite part of SPAC arbitrage. My number one favorite is its low risk profile. So buying a SPAC at or below NAV is basically buying less liquid T-bills, because we know we're guaranteed, as long as we can hold for the tenor of the SPAC, 2 years at most, we're guaranteed to get our money back plus accrued interest. So let me rephrase that. We're guaranteed to get the $10 back plus accrued interest, as long as we can wait it out and not be forced to sell. So it's very low risk if you have a longer term time frame, because you can get T-bill return plus accrued interest. And we have effectively an embedded put on the SPAC due to this redemption or liquidation feature. And combined with the SPAC pop, it presents a risk profile such that we have the downside of T-bills, albeit less liquid T-bills, and combined with the upside of equities. So not a lot of places where you can get equity upside with T-bill downside. So my favorite way to play SPACs these days is the arbitrage in units. So looking at the current numbers out there, there's a ton of new issue units. Many are trading at or below $10, which is great, because in most of them you get free warrants. Average SPAC warrants is trading around $1.30, and the average business combination is announced 230 days after its IPO. Let's call it 9 months. So in those 9 months, if you can buy at or below $10 and then exit at a 19% premium to NAV, which is the average of the 128 SPACs that have announced a business combination but not yet closed it, that's a pretty phenomenal opportunity for a low risk investment strategy. So the market's pricing in 19% return with the downside of T-bills, assuming that you own all the SPACs. So it's important to buy at the right price and sell at the right price. There is arbitrage opportunities in common shares as well. If you just buy and hold into redemption, got to caution investors on this, especially retail investors. The retail platforms, they're discount brokerages, and they're called discount for a reason. They're not high touch, and they don't make redemption easy, and some charge quite a bit of money to do it, whether it's $50. I've even heard a few $100s. So caution on the redemption, because if it's screwed up, then it can drop dramatically. And one that I saw recently happen, GIK, Gig Capital 3, no longer a SPAC because they had the redemption go through already, but many were stuck with a post-SPAC equity that was significantly below $10 per share. But there's a lot of low-risk arbitrage opportunities in the common shares of SPACs, and now there's well above 300. So post-SPAC equity trading dynamics, after the de-SPAC transaction, when it converts from one asset class to another, it converts from a SPAC to a post-SPAC equity, which you should definitely know that they're completely different asset classes, because you lose that embedded put, you lose that $10 plus accrued interest floor price. And that is key. That is so key. If you just bring one thing from this webinar, understand that that redemption is incredibly valuable for protecting downside for investors. So there's a lot of criticism on post-SPAC equity trading dynamics. And from our research, it does follow a Pareto distribution where you have a few huge winners, like a DraftKings or something of that nature, and quite a few losers, kind of like an 80-20 rule. So of the past 83 business combinations that have closed over the last 12 months, they've had an average return of about 20.6% and a median return of 10.1%. And that's ignoring the warrants, and the warrants can add a significant return on top of that. So where this strategy can go wrong, and it is a low-risk strategy, but not no risk, because I see time and time again, many investors, they make a mistake and they miss the redemption process. This strategy is simple but not easy, requires a full-time team, and requires a diversified portfolio. You got to hold a lot of SPACs, because ultimately you don't know which ones are going to do well and which ones won't. We saw a lot of high-profile ones that were trading at large premiums announce a deal and then go on to trade at a discount. One would be Thoma Bravo or some of the Reid Hoffman SPACs. So it's important to know when the redemption date and how to affect a redemption, because I even have institutional investors calling me up and be like, oh, why is my SPAC at $8 down 20% today? What happened? I thought this was low risk and had a floor. Well, they didn't realize they crossed over the redemption date, and now they're stuck holding a post-SPAC equity, nursing large losses. And that's where the strategy goes from low risk to high risk, is if you're not following every single filing on Edgar, marking every single key date such that you're aware of every single corporate action. And that's really the key to the strategy, knowing the corporate actions, having access to IPOs, which we do, and having a seamless redemption process. Another aspect that I really like this strategy is the diversification benefits of SPACs. So if we look at the time period, the first 5 months in 2020 was the most volatile period on record for markets. We went through the start of the COVID pandemic, the S&P tanked 35% in a month. We had the TSX tank 38% that month. We had the VIX reach 85, its highest level on record. So certainly a stressful period. That's great for battle testing strategies, right? And if we look at the blue line, the Accelerate SPAC Index, and compare it to bonds, the orange line, supposedly safe bonds, over the first 5 months of 2020 returned 2.1%, with a volatility of 7.7 and a peak drawdown of nearly 9% in March 2020. And we compare that to SPACs, which were already hitting new all-time highs by April, and over the first 5 months returned 3.8%. 3.8% with a vol of 5.3% and a peak drawdown of just 6.6%. So if we look at the most volatile period in the history of markets, SPACs not only outperformed supposedly safe bonds by 1.7%, but did it with 31% less volatility and 25% lower drawdown. They say you can't eat Sharpe ratio, which is risk-adjusted returns, but when investors are nursing large losses, 8.8% with respect to bonds and 35% with respect to equities, you sure can eat Sharpe ratio at that point. So as we all know, diversification is the only free lunch in investing, and SPACs really serve as a great diversifier because they are an alternative asset class, and they do or have historically had a negative correlation with both stocks and bonds, which is great from a diversification standpoint. I see investors sometimes complaining, oh, the market's up. Why are SPACs not doing anything? Well, that's because they are uncorrelated. That's what an uncorrelated asset should do. It should not, its moves should not depend on the moves of other asset classes. So over the first 5 months of 2020, SPACs were actually negatively correlated with bonds and stocks. So it's an important thing to note when you're looking to diversify a portfolio. The key is to have as many positive expected return, uncorrelated strategies. So how to get access to SPACs? Well, I run the world's first SPAC Arbitrage ETF, ARB, on the Toronto Stock Exchange. It's the Accelerated Arbitrage Fund. We hold a portfolio of over 200 SPACs. We do have access to SPAC IPOs. I've invested personally in over 300. I've analyzed probably about 700 SPACs. So I think I'm probably one of the most experienced on the planet. If not, I'm not sure if anyone's invested in more SPACs than I have. And in terms of performance, we just wrapped up our first year as a public ETF. Used to run our arbitrage strategy as a private hedge fund for 6 years, so 7+ year track record. But over the past year, return of 40%, Sharpe ratio of 4 versus the average hedge fund Sharpe ratio of roughly 0.4 to 0.5 times. So our risk-adjusted return is about 10x the average historical hedge fund return. So great performance, super happy with it, and it's accessible to everyone. So it's really it fits with our mission of democratizing alternative investments and allowing everyday investors to have this strategy professionally managed from award-winning managers. So ARB ETF is the one that I manage. So I'm going to wrap this up prior to getting to questions. So a few key points you should know. SPACs, rapidly growing asset class, went up 10x year over year. There's now well over 500 of them. However, at 200 billion, they're still very small compared to other asset classes. And for the people saying, oh, SPACs are dead, they're done, we're still in the first inning. I believe 2020s will be the decade of SPACs, and they will mature over time to be an asset class similar to private equity, similar to venture capital, similar to hedge funds. They'll be kind of along the same lines. So I see continued growth globally for SPACs on a more measured basis. It won't go back to the frenzied ways of the past. Why should you pay attention to SPACs? Well, they present an exceptional arbitrage opportunity. In my opinion, they're probably the most inefficiently priced market out there. If you're looking at large cap US equity, highly inefficient, difficult to make money, difficult to generate alpha. Contrast that with SPACs, highly inefficient. It's very easy to create an informational, analytical, and trading advantage over other market participants in the SPAC market. And there aren't very many markets that trade that inefficiently, allowing investors to generate substantial alpha. In addition to that, they do present an uncorrelated asset class, which is what investors should look for when structuring a diversified investment portfolio. And ultimately, SPAC arbitrage presents a heads we win, tails we win big strategy, because you have the risk profile of T-bills plus the upside of equity. So the risk reward profile is just pretty phenomenal. Granted, you buy at the right price. So that is key in this whole strategy, is buying at the right price. And you got to be disciplined. You got to have a tight back office and your operations in check. You need a full-time team to run this well. And if you don't, then you could make mistakes, which could be incredibly costly, turning a low-risk strategy to a high-risk strategy. So ultimately, given the unique and attractive characteristics of SPACs, investors should consider a diversified portfolio of blank checks in their asset allocation, or hire a professional manager to do it. You know, there's our ARB ETF, there's some other SPAC ETFs as well. So feel free to reach out. Follow me on Twitter at Julian Klymochko. I'm always tweeting about, you know, various things in the market. Flip me an email, give me a call. And this presentation will be posted on the events section of our website, accelerateshares.com. I will now move on to the question period. So let me get to the questions here. All right, going in the chat here. What impact will the new SEC warrant accounting guidance have on structure of new SPACs? So we did see a couple IPOs that were warrantless. So I believe we'll see more warrantless SPACs, which is unfortunate because that punishes investors because our returns will be lower. And it's really only the kind of the top tier firms issuing warrantless SPACs. I'm not sure why. I was thinking about that last night, and perhaps we'll see more overfunded trusts where the trust could come out at $10.20 or so to make up for the lack of warrant, or we could see rights. You know, some SPACs do issue rights as well. So I wouldn't be surprised to see warrantless SPACs, but with overfunded trusts and rights attached to them. All right, have you considered listing ARB on a US exchange? Considering it, but still working through the process. So if anyone's interested, feel free to reach out. What SPAC innovations or derivatives are you most excited about? I mean, I like all of them. I think the G Corp could be cool. CPCs and the TSX Venture, those are always fun. The sales structure. It's nice to see sponsors put up there, like what James means by the sales structure, and there's others as well. I believe CAPS is another one, is sponsor promote that is performance oriented, i.e. they get these free shares depending on stock price, $12, $15, $20 per share. So that is a good thing. I mean, we want to see sponsors put together good deals and get paid if investors do well. So from Patrick, how much do you think short sellers are contributing to downward pressure on SPACs? Perhaps taking advantage of largely retail investor base, and what structural improvements help mitigate that? Yeah, so that's important. Like, number one thing is to differentiate between SPACs and post-SPAC equities. I have seen a number of bear raids on post-SPAC equities. There's actually one today on Danimer. And before you get scared of that one, look at the short sellers report on XBO, which is up about 3x since the short report and hitting new all-time highs. So it's important to think about what exactly is going on. If there's fraud, and there has been some, I mean, what Nikola did, I thought that was awful for the markets to see how they kind of pull the wool over investors' eyes. That's super negative. And to the extent that, you know, that's positive when they get shared with the market. So there's kind of positives and negatives with respect to short reports. And, you know, I short stocks all the time, so I'm not against shorts. But clearly shorts are piling on post-SPAC equities because there's a lot of weakness and they're largely short term. So for example, if someone puts out a short report today, they could already cover their position into the weakness. They typically load up on short-term put options and just trying to get that increase in put option price just to maximize their profitability. So they're not in it for the long term. That's one thing to consider as well. and definitely capitalizing on weakness in post-SPAC equities, which has had the effect of basically being transferred to SPACs. And so SPACs don't really get shorted too much, especially if they're below $10, because that's a guaranteed money-losing trade. And prime brokers typically don't lend out SPACs, just because going into the corporate action, like if someone's going to redeem a SPAC, that means that those shares are no longer available to be shorted. So they'll be forced to buy in anyway. So pre-deal SPACs, you don't see those being shorted at all, and typically brokers don't lend them out to be shorted. It's different for the ones that are at very lofty valuations, CCIV, etc. You know, you could see some shorting on those. It's because they're less owned by hedge funds and more so by retail, and so those retail platforms could lend out their shares. So yeah, it's kind of what I'm saying. So just beware of post-SPAC equity weakness and short sellers capitalizing on that, and you know, do your due diligence, and ultimately I have conviction that will allow you to stay the course irrespective of what other people say. You know, there's smart people making calls on stocks all the time, and I have seen some, you know, I saw a very incredible short on Tesla after the IPO at $30, which split adjusted would be around $8. And if you look at that person, if someone shorted there and kept it, they would have been bankrupt like 500 times over. So shorts aren't necessarily correct. So take that into account. Another one from Desmond. What impact will Asian SPACs have on this asset class? I don't really follow the Asian SPAC market. I don't really think there's much. Perhaps there's been a few issues, but you are seeing North American listed SPACs do business combinations with Asian companies. For example, Grab was one. So I think that's positive to look internationally to get world-class companies going public via a blank check company. From Kumar. He says, now that we have over 500 SPACs from which IPO'd in the last 6 months, what seems to be the new normal and time frame wise we can expect the next SPAC bull market? So like I said, judging historically, we've seen 4 cycles over the past year. Past performance is not guaranteed future success, but yeah, I wouldn't be surprised to see kind of 2 more cycles this year: bull market, bear market, bull market, bear market. So remember, this is a highly cyclical market that's sentiment driven, and things can pick up very quickly. And you know, I wouldn't be surprised if we're back in a bull market this summer. Are rights publicly traded like warrants? From James. Yes, they are. So there's a handful of SPACs that do have SPAC rights. From Emmanuel, how long do you see a transition from current bottoming out to the advent of a new SPAC bull market playing out? Any perspective on forthcoming new SEC rules and guidelines? Davis Polk in particular has warned on some tangible changes on the horizon. Yeah, I think one of concern would be changing guidance on offering forecasts. You know, people are concerned about that, but typically the SEC hasn't done, you know, any sort of massive changes. First, they warned on celebrity SPACs, which, you know, by all means, that was a really good move, because people should never buy anything because a celebrity is behind it. You know, it's kind of ridiculous how they actually had to say that. And then the change in the warrants, and it's kind of pointless, has no fundamental effect except slowing down new issuance, which I guess was positive. But yeah, it's kind of a make work project for sponsor teams and accountants out there. So new bull market, you know, this is all just estimates, guesstimates, and forecasts. But like I said, I wouldn't be surprised to see a rally into the summer here. How to hold the Accelerated Arbitrage Fund in an Ameritrade account. I'm not sure if that's possible. I know that we do have clients from Fidelity and Schwab Global. Is your position sizing based on how much you're allocated, or do you have for same on every deal? You buy after IPO to even it out? I assume not. If you had an IPO pop, would eat into that yield. Average investors can't get into IPO at 10, so often would have to buy in after IPO. Yeah, so our rule is we never, ever, ever buy at a premium to NAV. So to the extent we can buy it at the IPO, we will. But if it trades up, then we won't buy it. We only buy at or below. So if you can buy it in the secondary market and at a discount, then definitely we will if it's an attractive SPAC. And I believe, okay, one last question here from Eddie. Do you see many deals getting recut? In what scenario would we see deals getting recut to lower valuations? Yeah, I think that's a fair comment. We will see deals getting recut because there's so many that are trading below NAV, indicating that they're going to get a flood of redemptions. And if they want to protect that cash and trust, then yes, they'll need to recut at lower valuations. So I think we'll see quite a few of those happening in the future, but stay tuned. That does it for questions. I'd like to thank everyone for joining us for the webinar today. Hopefully it was helpful. Feel free to reach out, check out our website, accelerateshares.com. Have a ton of information on there. Hope you have a great day. Thanks, everyone. Take care. Bye.